like goodwill, fixed assets, then the investments are given and the current assets also, and at last they have a preliminary expenses also. After that, few adjustments are given. Now, the steps for solution of this problem is very clear. We'll prepare first the changes, statement of changes in working capital. But there are maybe possible some adjustments regarding the changes in working capital also. So we need to identify whether we have any adjustments which will be affected to the changes in working capital. If it is not there, then we will start by the first step, that is changes in working capital. The first adjustment is actually company capitalized some amount from the general reserve and issued bonus shares to the existing shareholders in the proportion of 2:1 at the end of the year, which is not related to this part of this. The next is also not related to the working capital statement, which is a part of right shares issued. Income tax is paid and income tax is actually concerned, that is not related to the working capital statement here. It is related to the working capital statement, as I already mentioned you. If there would be any adjustments regarding the working capital, regarding the income tax provision or provision for taxation, then that provision for taxation would not be considered as a current liability, but instead of that we will prepare a separate account. So here provision for taxation would not be considered under the current liability. So that is not an adjustment, but we will actually take it in a different consideration. Investments, not at all to be considered here. Machinery, no. Debentures and conversion of debentures and redeeming the debentures, not at all here. Expenses for issuing right shares, that is also not to be considered here. So now we will start the first part, that is the statement of changes in working capital of the respective problem. So here we'll prepare the statement of changes in working capital, statement of changes in working capital. Now see here, the same type of format we are preparing for the same. And on the basis of that statement, we will identify whether the increase or a decrease of working capital. Years are given 2005-6 and 6-7. Just confirm whether it is right or wrong. Increase and decrease in working capital. Years are 2005-6 and 6-7. That's right. All right. Now, just make it the particular part of the informations. Now, all of you refer your balance sheet. On the basis of that balance sheet, we would be identified some current assets and current liabilities. So let's begin with the asset side and identify the current assets recorded under this title. First is goodwill. Goodwill is not a current asset, so it won't recorded here. Fixed assets is also, investment is also. Start with the stock. First is your stock, 45,000 and 60,000 is given. So stock 45,000 rupees here in the last year and 60,000 rupees in the current year. So the formula is very much clear. If the current year current asset is higher than the last year, it would be considered as an increase in working capital. Now see the next item, that is debtors. Debtors is here, the last year debtors are rupees 37,000 and the current year is 42,000. So 37,000 and 42,000 rupees debtors. In that sense, the difference of the debtors is actually 5,000 rupees. The debtors amount 5,000 rupees difference, and that is also shows the current year current assets is higher than the last year, considered as an increase in working capital. Next is bills receivable. Bills receivable, if you are going to see, here it would be little reverse. Last year it was actually 46,000 and the current year is 38,000. So 46,000 and 38,000, it means current year current assets is lower than the last year. It's a decrease in working capital. Current year current asset is lower than the last year. It shows a decrease in working capital. We are simply using a formula. If the current year current asset is higher than the last year, it's increase, and the current year current asset is lower than the last year, it is decrease. Next is after bills receivable, cash and bank. Cash and bank last year is 12,000. Yes, it is 12,000 and the current year is 29,000. Again it shows the difference is last year is lower than the current year and the difference is 17,000, which represents that the increase in working capital because of the current year current assets is higher than the last year. Then the next is preliminary expenses. Preliminary expenses is not at all part of current assets. So the total current assets are for the last year is, make a total of simple these things. So 7, 6, 13, 18, 20, 0, then 6, 9, then 13 and 14. The other current year total is the total of the last year current assets is around 1,40,000 and the total of the current year current assets is 1,69,000. Now less current liabilities. As we find out the current assets from the balance sheet asset side, we need to identify the current liabilities from the liability side. See the liability side, start with the equity share capital, it won't consider here. Preference share capital is also not a current liability. Then 3 reserves in surplus is also not a current liability. Debentures, it's a long-term borrowed funds, not at all considered. Proposed dividend cannot be considered because of it's a different type of provision, it cannot be considered as a current liability. Provision for income tax. In the previous question we consider as a current liability because there were no adjustments at all regarding the PFT. But here we already refer that we have an adjustments regarding the PFT and that's why we will not consider PFT under the banner of the current liability. We will open the separate account and treat provision for taxation in that case. Next is depreciation fund. Depreciation fund would be treated directly to the fixed assets account. It will not consider under the heading of current liability. Next is creditors. So the creditors is a current liability. And just confirm the creditors value in the last year is 40,000 and the current year is 46,000. 40,000 and 46,000 rupees. Now see the difference. The current year current liability is higher than the last year. It will work reverse than that. That is decrease in working capital. Here it was the current year current assets higher than the last year, it is increase. But in case of creditors, current year current liability is higher than the last year, it's decrease in working capital. So the reverse than the last time. Next is outstanding expense 8,000 and 11,000. Just make a confirm 8,000 and 11,000 rupees if I am not wrong. Yes, and this is also shows that 3,000 rupees difference and the 3,000 rupees current year current liability is higher than the last year. So it means it is a decrease in working capital. The next is bills payable, and bills payable amount is 14,500 and 34,200. So again it shows the difference is higher than, that means the current year current liability is higher than the last year and the difference amount is 19,700. Difference amount is 19,700. That's it. We have three current liabilities. Make a total of that. The total current liability it comes to 62,500 rupees if I am not wrong. Just make a confirmation that whether it is right or wrong. 62,500 rupees total current liability. Just making a total of this 6, 1, 7, 11, 1 carry 5, 6 and 9. 91,200 rupees of the total current liability in the year 2006-07. Now we will find out the net working capital. So net working capital is a difference of A and B, current assets minus current liability. Here the last year 2005-06 current assets 140 and the current liability is 62,500. The difference it comes around 67,500 rupees net working capital in the last year. Just make a correction, it's 77,500 rupees net working capital in the 2005-2006, and in the other year we will find out that is 77,800, if it is, yes, 77,800 rupees difference of net working capital between the current assets and current liabilities for the year 2006-7. Now we'll just identify which side is higher. We don't know actually, because of it the difference is very minute, so you may not be identified which side is higher. Just make a total of both the sides, and the total of the increase side is 37,000, and the total of decrease side 22, 28 and 36,700. So see here the difference is 300. Here also the difference is 300, but which side is higher? Increase side higher, so that means your answer is increase in working capital. Your answer is increase in working capital. That's your first step for this question, where we find out the increase in working capital. Anyway, also you can find out the clue that whether your answer is right or wrong. The answer is showing the current year net working capital is higher than the last year by 300 rupees. So it shows that if the current year net working capital is higher than the last year, it's increase. And anyway also you can identify here also the 300 rupees increase in working capital. So this is what your first step, that the statement of changes in working capital. Now moving to the second step. Second step, as we discussed, that we are preparing adjusted profit and loss account along with the necessary ledger accounts, and the necessary ledger accounts we will identify from the adjustments. Here there are, because of it, I'm going to say that there are many ledger accounts supposed to be prepared here. So maybe we will prepare first ledger accounts instead of the adjusted profit and loss account, and then we will prepare adjusted profit and loss account. First we identified which are the ledger accounts to be required. See the first adjustment. Company capitalized some amount from the general reserve and issued the bonus shares to the existing shareholders. So that means one is equity share capital is required, then the general reserve is required from the first adjustments. Now see the second adjustment. Company issued right equity shares in the ratio of 5:1 after issuing a bonus shares on increased capital. Equity share capital as account is already drawn, so that's not an issue. Income tax paid for the year 31st March 2006. So we need to prepare, the next is provision for tax account. So provision for tax account is required for the same. Now we see the next adjustment is investments sold out at the profit of so and so. So we need to prepare investments account also. Then see the next adjustment is real valued of machinery is rupees 12,000 and accumulated depreciation is 7,500. So we need to prepare machinery account. Just check it out the balance sheet whether we have a machinery separately given in this balance sheet. No. Instead of the machinery we have a fixed asset. So instead of machinery account we need to prepare here fixed assets account. Then the next is 1/3 debenture out of the total debentures are redeemed at 104. If you want to prepare the debenture account you can prepare, but ultimately it is simply redeem the debentures, so that as such there would not be a major difference in the debenture account. If you are going to see the debentures, the opening is 150 and the closing is 1 lakh, and 1/3 debentures is going to write off, that means the 50,000 rupees of debenture is write off. So you can easily understood how much amount of value has been write off in the debenture. I don't think so we need to prepare a separate account for the same, so I'm not going to draw it here. Expenses for issuing the right shares is to be written off in 9 equal installments. I'll tell you the preliminary expenses account we need to prepare for the same. Preliminary expense account for the same, because of it's related to that account. Just see anything else? Yes, we prepared a fixed assets account, but simultaneously we need another account, that is depreciation fund account. And why we prepared depreciation fund account, I'll tell you. Because of fixed assets account is here and the depreciation fund is given in the balance sheet liability side, so that would be affected to the fixed assets, and on the basis of that we would be calculated certain values. That's why we prepared here the depreciation fund account here. That's it. These are the adjustments regarding this question, and we already drawn out the necessary ledger accounts in front of you. Adjusted profit and loss account I'll prepare later on, because of I need this place for doing some working. So I'll show you how to deal with these transactions. Now let's start with the opening and closing balance to be written in the respected account. Start with the equity share capital. Just all of you refer the balance sheet. Equity share opening balance is 3 lakh and closing is 5,40,000. As I already told you, equity share capital have a credit balance. So opening balance is on the credit side by 3 lakh rupees. Yes. And the closing balance is on the debit side. That is 5,40,000 rupees. Moving to the next item, we have another account is general reserve, that is also credit and credit balance. So start with the credit side, opening balance 380. 3,80,000, and the closing balance is, see the balance sheet, current year balance is a closing balance, that is 2,40,000. Moving to the next regarding the provision for taxation, that is also your liability item. So opening balance written in the credit side first, that is 40,000. And when you are going to see the current year closing balance, that is 65,000 rupees. So that would be written on the debit side as a last item, 65,000. Yes, it is. Now next is investments. See the balance sheet asset side, and from the asset side third item you can identify your investments value. It's 155 and 60, but investment is an asset, so start with the debit. Opening balance is written on the debit side, and that is 1,55,000, and your closing balance written on the credit side, that is 1,60,000. Now after investment, what next? The next item is fixed assets. See the fixed assets, opening is 8,15,000 and closing is 9,02,000. 8,15,000 and the closing is 9,02,000. So this is your fixed assets balance. Now let's begin one by one all adjustments. Here start with the first adjustments here, and that is company capitalized some amount from general reserve and issued the bonus shares to the existing shareholders in the proportion of 2:1 at the end of the year to 31st March 2007. That means it's a current year. In the current year the company offered a bonus shares. Now as per this, the working we will prepare. Just see the working number 1, bonus shares. The proportion of the bonus shares is 2:1. If the shareholders have 2 equity shareholders of the particular company, they will get 1 bonus shares. Now see the capital, equity share capital is given. How many number of shares is given? 3 lakh rupees of capital is given. So existing capital is 3 lakh rupees. If the face value is not given, and if you want to assume that, you can assume it also. Otherwise, if you applied this proportion on this existing capital, your bonus amount would be easily get it, that is 1,50,000 rupees. Because of if you have 2 shares, you will get 1 bonus, then the 3 lakh rupees existing capital, your bonus amount would be 1,50,000. 1,50,000 rupees. And the bonus is actually given, the company capitalized the sum amount of general reserve and issued the bonus shares. So the 1,50,000 rupees of the bonus shares is given from the general reserve. Now, first journal entry, if you are going to make it, it's very simple. General reserve account debit to equity share capital account. General reserve account debited to equity share capital account. It is ultimately, if you remember in the theory I told you, if any changes would happen in the same block, it cannot affect it to the fund flow statement. There it is not